All right. Welcome, welcome, welcome. Welcome everybody to the Around the World 10 surprises, 10 potential surprises for 2026. It's Mark Yusko from Chapel Hill. And as people are dialing in here, I will say one, Happy New Year, even though it's late in the year to do that. And then I will apologize up front. Um, this was scheduled originally for last week, kind of the second week of January. We had some things move around. I had to be out of town, so we bumped it to this week. And as I can't remember the name of the law, but if you only have a certain amount of time to finish something, you will finish it. Well, if that time expands, you'll do more. So I did too much. So I have way too many slides. So I'm going to go over today. So for anybody who has to leave at an hour, I will apologize up front. So you guys know how this works. The definition, the surprises are not predictions. They're variant perceptions, 50-50 chance of happening. But if they happen, you can make good money. I haven't read anybody else's lists, and there's a lot of folly about this. They're hard. And those who have knowledge don't predict. Those who predict don't have knowledge. So a year ago, DJT was rocking the mic on New Year's Eve as the Bulls partied all night long and everything was at new all-time highs, but baby New Year was feeling a little burdened. So we're going to do a quick review of last year's surprises. Last year, the surprises were brought to you by House Stark. Now, I did this last year. I asked ChatGPT, what's the consensus? And it, gave me this just horrible image. I mean, just full of hallucinations, but it, eventually did give me the consensus. And on the right, you see the green ones where consensus was right. The red is where consensus turned out to be wrong. Last year, people worried about trade wars, inflation, and rising rates. Those were indeed the things. We talked about trade wars a lot. We didn't talk about inflation very much, and rates actually went the other way. So the scoreboard, 6 and 5, which kind of what you'd expect. Contrarians edge out the consensus and momentum. And just for fun this year, I should have done this in other years, but I actually put an equal weighted basket together of the ideas in the surprises. And the market was up 18% and the basket was up 31.8. So it kind of goes to the point. It's not whether you're right or wrong. It's how much you make when you're right and how much you lose when you're wrong. So surprise number one was that recession would finally arrive. Wrong. Vanquishing recessions forever and cutting rates when GDP growth was over 3%. J-Pow is still Trump's favorite whipping post and likely out of a job this year. We talked all about how the GDP was going to remain buoyant because of deficit spending. The data actually looked pretty good. So look, there was no recession in 2025. The red says is a new slide. GDP growth actually looks strong with a caveat. So almost all of the growth in the first half, and then we'll talk about the second half later, came from spending on AI. So other than building a bunch of data centers, there wasn't a whole lot of activity in the US. So surprise number two, the surprise was that, printer is coming, that J-Pow would actually cut rates, not raise rates. And we got that one right. He did cut multiple times. And more importantly, they stopped shrinking their balance sheet and extended repo lines. The only thing we didn't get exactly right was TLT didn't benefit from that, but that's okay. So the shape-shifting Fed chair said, I can fix it. He lowered rates, but short-term rates, but long-term rates went up. That's not the way it's supposed to work. And they did shrink the balance sheet, and that global liquidity did help the S&P go up. Now, J-Pow donned the cape and took the sword to Fed funds, and 10-year rates eventually did find their way down. So it was mission accomplished all the way around. The bear and the maiden fair. This one, we thought that the bear would get out of ICU and make a reappearance. Talk about being wrong. This surprise had a useful life of exactly 1 day. SPX was down 20% for a single day in April before the taco, Trump always chickens out, turnaround. The bear went right back to the ICU, and stocks finished up about 20%. Now, the economist last year said, why would you ever bother investing in anything other than U.S.? I mean, other than the fact that they're highly valued. No one thought markets would go down because they pretty much never did. No one ever bought any protection. Trend is your friend, so that was going to happen. And like I said, literally 1 day in bear market, and then bear went right back to ICU. So surprise number 4, law of gods and men. We thought that MAG would stand for must acknowledge gravity. Again, this surprise had a useful life of about a month, not a day. MAG 7 actually fell 30% from the time we did the surprises in January through April with the trade war escalation, but the turnaround was huge, and AI mania pushed the MAG 7 up 65% from the April bottom to finish up about 20% as well. So the top 10 stocks, the super concentrated, everybody believed in AI. Valuations were reasonable if you believe the growth. The growth didn't come in the way people thought, so they were less reasonable, but still big on big, bigger than France, bigger than Canada, bigger than Mexico. In AI, we trust Momo Tech, all the rage, escalator up, elevator down. It started that way, and then the escalator just kept on trucking. So you can see MAG 7 fell down the elevator shaft in Q1, bailed out by the taco trade, and finished up big. So surprise number 5 was long-term trend in the dollar remains intact, and DXY shrivels back to Bruce Banner form. Wow, got this one super right. It was one of the worst years in the post-World War II era for the dollar. Petrodollar unraveled, China sold treasuries, everything went against the dollar. And, the dollar was due for a correction. Goldman last year didn't think that was positive. Didn't think that was possible, but they always think the trend is your friend. Nothing against Goldman. They all do. They get paid on that. Have to keep the recent move in perspective. It had rallied a lot when Trump got elected, but then it gave all of that and more back. And it was actually the second worst year this century, which is saying something. All right. The House of Black and White, surprise, really never had a chance. The Saudis never turned off the spigot. They claim they need $85 oil to balance the budget, but they're not getting it. And we surged briefly to $75 on the Iran war, which lasted about 5 days, but relentless U.S. production led to lower and lower prices. So, as the EIA always does, they said prices would be flat, and they weren't. In fact, they just drifted down. And holding the 200-day moving average in the red circle was important. That never happened. Energy stocks, we thought, were wildly out of favor, and it might be a good time to buy some. Oil stocks, like all stocks, were an amazing buy in April. And the services names were even stronger, and they have gone on to just crush it here in the first part of January. So surprise number 7, the red woman. Call her crafty, call her crazy, but Ms. Lagarde certainly cunning as she somehow managed to cut rates 4 times and have the euro go up 14%. Normally, if the euro surged in a country or a set of countries that are dependent on trade, basically stocks should have gone down, but instead they went up 40%, and that was on no one's bingo card. So we got this one pretty right. And she basically chopped the heck out of interest rates. There was no economic growth, so it wasn't about that. The mercantilist, they need a weak currency, but they didn't get a weak currency. They got a strong currency. And yet, despite the cuts, the bonds caught in the global bond sell-off, they should have hurt the banks, but the banks went up even more than stocks. So the euro went up, euro stocks and banks soared. Euro bank stocks, look at that on the right-hand side, went up almost 70%. I mean, it was an extraordinary year for European, and despite the fact that people claim there are no good investment companies in Europe, except people like my son-in-law. So surprise number 8 was about Japan, the Night of Seven Kingdoms. The new central banker, Ueda-san, clung to his academic theories. He pushed the yen up to 140. The Nikkei went down 30%. So he went wax off in April. The yen went wildly crazy down back to 160, and the Nikkei finished up 30%. So it really is all about the yen in Japan. If the yen is weak, stocks will go up. If it's not, the opposite. So you can see Ueda-san not very happy about his moves. Deflation has gone. Inflation's back. And Japanese equities were dead money for a year. All they needed was a weaker yen. And that's exactly what they got starting in April. And Ueda-san got his tap on the shoulder and bang. So surprise number 9, that the dragon market would continue to fly despite the tariff talk. Got this one super right. First half of 2025 was all about the on again, off again, Trump trade war with China. But in the end, Taco won out. Dragon market ignored the headlines and doubled the U.S. markets, up 40%. China was in a bad place, but cheap a year ago. Their earnings were growing a lot, twice as fast as the U.S. and Europe, but the stock market hadn't made any ground, so it seemed like a good trade. Media thought it was a dumb idea, as they are prone to do. Foreign holders of debt. China has a plan. They are selling U.S. treasuries and they're buying all that glitters. We'll get to that later. So they have this plan that they have a lot of leverage if they don't buy our treasuries, because they don't, who's going to? And we owe 37 trillion of those babies. So lower rates in China also mean more capacity for the PBOC to inject liquidity. So maybe that was their plan all along. Their trade surplus soared to $1 trillion, got even better than that. Chinese tech stocks were super cheap and they outperformed. MCHI and KWeb beat the S&P and Triple Q. So dragon market roared away. So the breaker of chains, we were right on this one, unfortunately. We were one of the few that thought that the 4-year cycle still exists. Humans are going to human, that prices would only get to 150. They didn't even make it that far. They hit 126 and they finished down 5% for the year. People didn't like that. Now, everybody thought that it was going to 70 and then back to 150. That is kind of what happened. Everyone talked about the crash. It's methodically followed the 4-year cycle. A lot of people are trying to say, oh, but that doesn't mean anything anymore. And the Bitcoin power law saying we're going, probably to 170, maybe even 200. The fair value proposition from the halving said we're going even higher than that, maybe 500 by next halving. So in 2028, things could get very interesting. And I actually do believe that. You can see the fourth halving here for 2024 says 63,000 fair value. We're at fair value around 91, 92 right now. So bottom line is, it's not a 4-year cycle. It's 3 years, 11 months, because it's based on the number of blocks. This guy on the left basically told us back in 2022 that, in 2023, in 2023, he told us that in 2025, October 6th would be the peak. It peaked exactly on October 6th. It's a little freaky. He kind of, says it's a simulation. We're living in a simulation. I'm not sure I believe that, but it is pretty freaky. Golden Crown, we thought the gold would soar all the way to 3,000. Oh my gosh. Right, but way, way, way too conservative. Gold not only wore the crown, but the barbarous relic smashed our target and went all the way up to 4,300. Yep, 65%. So we're in the cycle that favors commodities. Gold tends to glitter more brightly after rapid dollar moves. There was a lot of background. Gold is poised to make a move. Miners were cheap. But look, we had no idea that gold would go up 65%. But man, look at those miners on the right. Miners went up 160%. I mean, crazy. Crazy. All right. So let's get 26 surprises brought to you by my favorite guy, Maverick and Goose. You've lost that love and feeling. That'll come up. So, man, last year I asked ChatGPT to make the consensus. It gave us this slop. Good style, but bad info. So this year, the style was less interesting. Info significantly better, but not great. Like I asked it about, what are the consensus? It said the consensus gold was going to go up from 2,400. That's kind of silly because gold was at 4,300. It said Bitcoin volatility around 100. Okay, that's fine. Oil prices, 55 to 65. That's actually pretty good. But the other stuff like European stocks, moderately positive in earnings growth. I mean, what does that even mean? So it was fine. So I gave Grok the same prompt and got complete gobbledygook, technical term. I mean, this is embarrassing that this is what I got from a prompt. I mean, it's nonsense. It's not useful. It's crazy. So Grok's second attempt was visually better, but just full of useless data. I mean, it got US GDP, it got a number. It didn't get the actual consensus number, which was 2.8, but at least it got a number. Interest rates, I mean, calling for 2 hikes when that's definitely not the consensus. And where copper plus 4% comes, it was totally useless. Now, the third time was the charm. I asked it again, and it looks nice, but again, mostly useless and wrong. It got GDP closer from 2.1 to 2.5. And I didn't enter anything. I just said, come on, you got to do better than this. It did have oil prices, but these to Segreve's supply. I mean, it's crazy. So the revised ChatGPT consensus graphic augmented by DeepSeek data. So I went to DeepSeek and got the actual consensus numbers that were a little better. ChatGPT did an okay job. I force-fed it the 4550 number, and it used that. I was like, come on, you're supposed to tell me what, because the consensus is actually we're going to 5,000. So the consensus on the right, graphic on the left is what it is. So in terms of fears, people are, and this economist cover is a little scary. We won't dig into it that much today, but it's warning of war, financial collapse, global unrest, packed with symbols of looming chaos. There's some spooky symbols in there. If you feed this into an AI chatbot and look at it, someone did a lot of work on that. So what do you think of the biggest risks? People think AI bubble, the Fed chair, credit, and geopolitics this year are the moves. All right, so surprise number 1, I will fire when I am goddamn good and ready. You got that? So Lieutenant Jerome Powell, call sign J. Powell, pulled off not 1, but 2 consecutive miracles and has steered the U.S. economy into the mythical no landing zone. Amidst the cheering on deck and the hoisting the mission accomplished banner, Admiral Trump can be heard harumphing that the nincompoop Powell must be incompetent or a complete fool, and he would like to fire him. Recall Trump picked him, despite J. Powell having piloted the economy through the longest period without a recession in history. It's a pretty great stat. The root issue is J. Powell's insistence that he will cut rates when he is goddamn good and ready, in direct opposition to the Admiral's nearly daily exhortations to cut interest rates by as much as 3%, despite 5% plus GDP growth in the fourth quarter. The surprise this year would be that the AI spending fueled growth dissipates, the K-shaped economy bites hard, the Admiral makes a pilot change, and the new guy crashes the plane. All right. So the GDP recovery in 25 was robust. We went from negative GDP in Q1 all the way to the latest revision of 4.4 in Q3. Now, most of it on the right-hand side came from this quote-unquote non-residential investment, the AI data centers. Some of it was from consumption, but that consumption number is not a real number. It is a trade distortion because of the tariffs and the just absolute collapse of imports. So it's a little bit, well, it's a lot, not real. Anyway, You can drive a truck through the estimates for fourth quarter. Goldman is over here at 2.1%. The blue chip consensus is at 1%, and Fed now is over 5%. I mean, come on. So really, the Fed now is really banking on this trade thing. I don't think that should really count the way they do it, but I don't get to make the rules. Wall Street prognosticators, KKR and Goldman, are basically calling for continued economic expansion this year, up to 2.8% from the Goldman Sachs forecast. So despite high expectations, and what I mean by that is on the left, you can see that in the beginning of 2025, expectations were about 70%-ish that we'd have a recession, and they fell all the way to 30%. Now, the chart on the right is what a heinous chart crime. I mean, that makes it look like zero, but it's 20% or 22%. So now they're saying 22% odds in 2026. I hate when people do that with charts. 3 of the 4 economic warning signs are flashing recession. Cyclical share GDP is down. Residential investment is down. Cyclical employment is down. The only thing that's up, and it is up a decent amount, is this non-residential investment, which is the AI data center spending. Now, the fact that we have been below the PMI's recession level of 50 for about 18 consecutive months is troubling. But, NBER hasn't called a recession. U.S. consumers have never been this pessimistic in the history of, there's always going to be a bunch of typos. So I forgot to take my notes off, but I'll take those off. And there's a good reason why people are pessimistic. One is they've depleted their savings. Savings are about to turn negative, up in the upper right. And then the second is they have about a 15% expectation that they're going to miss a debt payment in the next 3 months. The sharpest increase amongst those age 60 and over, with a high school degree or less. So this comes to this cognitive dissonance of, well, if everything's so great, why do people feel so cruddy? Well, it's explained by the K-shaped dichotomy. The affluent are doing great. The people at the bottom of the pyramid are doing less well. And so it describes the recovery of economic state where different segments of population or industries or wealth levels change divergent drastically, resembling the Leonard K. And it basically goes to, are you an owner or a renter? If you own stuff, you're feeling great because your assets are going up. But if you have to rent or buy stuff, life is not so great. Household net worth, highest ever. But that's equity. Yet the worker's share of economic income is the lowest ever. So it's all funneling up to the elite class, and that is why the average person doesn't feel so good. Now, when you look closer, the confidence reflects where you are on the K scale. So if you make more than 125K, you feel great. If you make less than 50K, you don't feel so great, or actually 75K. If you own a lot of stocks, you feel less bad. Now, you still don't feel good, which is interesting. If you don't own any stocks, you feel really, really badly. The haves continue to spend, but the bottom of the K keeps shrinking. So now the top 10% of earners spend half of all spending. So the inequality is rising at a rate that we haven't seen in a very long time. So when job growth reaches this level, the chart on the left, when that white line gets down to 0, we've never not had a recession. Like 100% of the time in the last 100 years, we've had a recession. So we're there. So technically, we should be in a recession. And when non-farm payrolls are down for the 12th time since 1950, the 11 previous times, we were already in recession. So there's something funny going on. When you worry about AI taking your job, on the bright side, remember that, for almost 80 years, 25% of GDP was firewood. So the world changes. When the Fed cuts rates, recession always follows. And again, there are no exceptions. And it's usually bad for markets. So people think rate cuts are good. But again, if you think about it, why would you cut rates? You'd cut rates if you thought things were getting less good and you needed stimulus. So that's historically why rates have been cut. So the Kondratiev wave theory indicates we're near the peak of the sixth wave. And that will be a market headwind. And what that means is that we follow these Kondratiev waves and they're long-term waves and they're punctuated by big innovations, whether it's industrialization or information technology, the newest one in terms of cognitive and biotech. But they're also then are punctuated by troughs that are financial crisis or depressions. And so on the right-hand side, when you get to the point where your 10-year returns are double digit, it's basically you're at the peak. Now, this chart is making the rounds. Samuel Benner made this chart in 1875, even signed this one. I wish I had one of these. These are cool. So he handed these charts out, and he was a farmer and turned commodity trader, turned investment advisor. And he basically predicted in 1875 pretty much all of the peaks and troughs, the major ones that have happened. He got 1929, he got 2000, he got the 82, he got 68, and they're not exactly right to the day, but they're pretty darn accurate, both the highs and the lows. So this is saying that this year, 2026, is the last of the good years, and then we go into about a 6-year period of downturn, which, will be less fun for people. So surprise number 2, if I can't shoot this son of a bitch, let's at least have some fun with him. While Jay Powell was celebrating yet another all-time high in the stock market to start the new year, he was served papers by the DOJ summoning him before the grand jury and threatening criminal indictment related to testimony in June regarding the renovation of the historic Federal Reserve building. You can't make this stuff up. President Trump has clearly been frustrated by his inability to influence Jay Powell to cut interest rates more dramatically and his inability to fire him. So, like our beloved naval aviator has decided to mess with him. As usually the case with ready, fire, aim decisions, it appears Trump miscalculated the impact said action would have on his desire to put his own dovish Fed chair in place, as GOP senators have now vowed to block any new chair until the case is settled. So the surprise would be that Fed fund rates just don't really matter. Global debt bubble pops, funding costs spiral out of control, and long rates reach Mach 10. All right, Fed watchers have pushed their rate cut expectations forward. Everyone thought we were going to have 2 rate cuts here quickly. Now they realize Jay Powell is going to cut when he's goddamn good and ready, and he's not going to cut because he knows he's out of a job in May. Maybe. We'll see. With this new court case, maybe he doesn't. So they pushed everything back to June, still banking on 2 cuts, but later in the year. Inflation is going in the right direction. It's not at target. So CPI is at 2.7. PCE in the middle came out this morning at 2.8. Now, the trueflation number is collapsing, right? The price of eggs is going down like crazy. And that was a big part of this because this is real-time pricing. So real-time data is collapsing. Everybody's saying, and actually Trump even quoted this trueflation number, which was 1.5 the other day and 1.2 today, at Davos, saying that, core inflation was 1.5. Well, it's not. Core inflation is 2.7, but trueflation, which somebody told him about, was 1.5. Now it's 1.2. So those are going in the right direction if you want to cut rates. The real issue is that the U.S. money supply growth is accelerating again at one of the fastest paces we have seen. We just hit a new all-time high yesterday of $22 trillion of money. And on the right-hand side, the Fed is restarting the not QE don't call it QE program of bond buying, and in size, like $8 billion a day. I mean, that's, this could get big in a hurry. So the real issue for debt is that U.S. government spending is completely out of control. The budget deficit on the left-hand side is already the second worst. If you adjust it for inflation, it's the third worst. The deficit at 1.8 trillion here, trillion there. Pretty soon you're talking real money. And again, this is not a political statement. It's just a fact. And it doesn't matter. Whoever was going to be president right now was going to get this because it's just the law of large numbers. But, Trump, 12.5 trillion, all other 44 presidents put together, 25. That is not an indictment of Trump. It just happens. It's the law of large numbers. Global rolling debt crisis, Europe last year, Japan under siege right now in real time, which we'll talk more about later. But the reality is that everywhere you look on this chart, right? The US, upper left, rates are up a lot. Okay, the UK, rates are up a lot. Switzerland, only place, okay, where it's not. Germany, Italy, everybody is having a debt crisis. Now, the US bond market is surprisingly relaxed. Now, it's relaxed at a much, much higher level, right? We're at 4%, 4.2% on the 10-year. And the 10-year did get a little jumpy the other day. That was a couple of days ago. Even though I said today, it was a couple of days ago. Got a little jumpy on the Europe and Japan news after the long weekend. So, look, we have a global debt crisis brewing. Now, how it plays out, we're going to find out, but it is interesting. Now, one of the places that has just been massacred is the long end of the U.S. Treasury curve. TLT down well over 50%. And yet, on the right-hand side, we are at this cathartic point in that when you see rising volume, the arrow on the left, into a low, you can get a reversal. Now, whether we actually get a reversal or whether people fret about the deficit, I don't know. But if we can break through the red line and that becomes support instead of resistance, right now it's resistance. And if we don't break it, as my friend Larry Tenerelli used to say, nothing good happens below the 200-day moving average. Look, the U.S. is the world's largest borrower. The problem is many, many countries, it's not just Japan, it's not just China, it's not just the UK, everybody is selling their treasuries. And so we now are seeing the lowest levels of holdings across the board since 2008, interestingly, global financial crisis. And again, pointing back to the Benner chart, that would mean is 2026, the year when the debt bubble finally pops. The real issue is the government, U.S. government, cannot, and I repeat, cannot afford higher rates because almost the highest level of short-term debt has to get rolled over, about 25% has to get rolled over, and we're already paying nearly $1.5 trillion in interest. So if suddenly this low interest debt has to get refinanced at 4 or 5%, it gets bad in a hurry. So yet corporate credit spreads are near the lowest ever. So what do? They issue lots and lots of bonds. So 95 billion in the busiest week since COVID. On the right-hand side, there's this little thing that doesn't make sense to me. So on the left-hand side, it says that credit spreads are the tightest they've been in decades. The right-hand side is what actually happened, okay, which is in 2025, more bonds were cut to junk than were made high grade. So in theory, the debt load was getting worse, not better. So the only thing that could have happened is a whole bunch of issuers at high grade issued and the percentages went down. So that's the only thing I can figure out. So there's just a lot of debt being issued. So the AI cash needs are fueling massive debt issuance. I mean, hundreds of billions of dollars. And so investors are responding starting in August with a doubling of demand for single name credit default swaps. Now, when people buy credit default swaps, that has historically not been a good thing. Whether it was European debt markets or whether it was, the AIG debacle. And in fact, the hyperscalers, right, their capital spending as a share of revenue has doubled from, well, it's actually quadrupled. Quintupled. No, quadrupled. It's gone from about 5% on average 15 years ago to 20%. It's only doubled since 2019. And so you can see on the right-hand side this alligator jaws that's forming where the credit spreads for the hyperscalers, and this is ex-Oracle, and we'll get to Oracle in a second, ex-Oracle, because if you included Oracle, it'd be horrible, versus investment grade. And you can, again, the correlation on the left-hand side is really, really tight up until the end of last year. So the bond vigilantes are noticing. Now, one company in particular is the canary in the coal mine. So, AMD, they don't have a lot of debt. Palo Alto, Google, NVIDIA, not a lot of debt. Apple, IBM, that's a lot of debt. Broadcom, HP, but Oracle makes them all look like pikers. Oracle default risk is at a new 3-year high, and it's starting to give off AIG vibes, not going to lie. Now, there are those who would say the only market indicator you need are credit spreads. Therefore, life is good. Just stop worrying about this and just buy stocks. All right, surprise number 3, despite your best efforts, you refuse to die. So the bear tried everything to concoct a downturn in the markets last year and managed to blow itself up again, ended up back in the ICU. That said, like Maverick, despite best efforts, the bear just will not die and keeps trying to jump out of bed and take a jaunt down Wall Street. While consensus 26 is firmly in the camp that Dr. Wang, Dr. Nadella, and Dr. Musk will keep the bear firmly strapped down in the hospital, there are a fair number of movie buffs pointing out that we've indeed seen this movie before, that the days of willing suspension of disbelief regarding valuations, growth, and profits are numbered. Some analysts echo the immortal words of Commander Tom Stinger Jardian, saying, if you screw up just this much, you'll be flying a cargo plane full of rubber dog shit out of Hong Kong. So the surprise in 2026 is the bear won't be happy till he's going Mach 2 with his hair on fire and U.S. equities crash and burn. Investors continue to pile into index and ETF funds, particularly in tech. I mean, like they're going out of style. I mean, it is breaking records just about every day. One quick reminder, there's no such thing as passive. There's only slow active. So yes, 58% of the assets are quote unquote passive, but they're not passive because on the right, over a 5-year period, 20% on average, sometimes more, sometimes less, 20% of the index turns over. So over any meaningful period of time, 25 years, you would have 100% turnover in the index. That's not passive. That's just slow active or just a momentum strategy. Now, never before have we seen 90% of people who believe returns will be positive. Okay? It had to happen sometime. It is the highest ever. And that's on the left-hand side. In the middle, the institutions aren't the highest they've ever been, but in the top 5. And then the reading of 93 on the greed and fear index or bull bear index is getting close to the highest we've ever seen of 96. So bullish sentiment rarely been higher. Individuals and institutions are both talking big. So the question is, why did Uncle Warren, before he retired, pile into cash and endure the worst period relative to the S&P that he's ever had? Now, is it Well, he just wanted to set his new guy up with a lot of cash so he could make his own track record. So is there a little sandbagging going on? No, that's actually kind of logical. Is it because he was worried? Is it that he knew that they were going to crash the markets and that he, do like he did in 2008 or 2002 when he bought up, or 2003 when he bought up all the low price stuff? I don't know. We'll find out. So why did individual investors put the largest amount of cash ever in money markets? I don't know. That's another interesting one. So institutional investors are betting that the Fed has eradicated volatility forever. So VIX positioning on the left-hand side near the lowest it's ever been. The net position is tied for the lowest it's ever been. The reality is that volatility is seasonal. And so mid-January usually is an interesting time for volatility. We did see a volatility spike earlier this week. VIX was not confirming the new equity all-time highs. And so you see, VIX had dropped sharply in December on the right-hand side. It turned sharply and actually then spiked here a couple days ago, has fallen back down, but it's still materially higher than it was in December. Now, when the VVIX is greater than 100, that's always a red flag, especially, and this is on the left-hand side, the red line, especially when the blue line is lagging. Now, the right-hand side is the 40-day cycle and the 80-day cycle for VIX. And basically what it's saying is mid-February is probably an interesting time to think about buying some protection. Doesn't have to work, but it's interesting. So earnings growth did contribute the bulk of returns in 25 for, only the second time probably in the last decade. Most of the returns of late in the bull market have been QE and multiple expansion. But earnings were good last year. So let's call a spade a spade. The problem is it's kind of a tough comp. When your earnings growth CAGRs at 15% for 5 years, that's as good as it's ever gotten. And we go back all the way to the 60s, it just doesn't get any better than that. So it's likely that earnings aren't going to be as good this year. The trailing 12-month real earnings relative to jobs. So this is kind of crazy. So when the jobs number turns down, earnings turn down. Now, earnings have gone the other way, at least estimates for earnings have gone the other way. So again, if you look at the chart, blue line, red line, high correlation. Is this time different? I don't know. Probably not. U.S. equities, when you take all of the indications of valuation, you put them all together, it's the most overvalued we've ever been on every measure, whether it's price to sales, whether it's price to book, whether it's, market value relative to M2, put it all together. We exceeded 1929. We exceeded 1965. We exceeded 1999. We are in a new world. U.S. equity valuations stretched across the board, big cap tech, small caps, S&P, equal weight, non-equal weight. Now, small caps are the least overvalued. They're actually in the second quartile, so that's something. Now, this is something interesting. When silver and gold both go parabolic, okay, so the two lines on the left are silver and gold. On the right is the conglomeration of silver and gold. When that ratio spikes, like it just recently did, and they put the numbers, 74, 79, 87, 98, 11, and 20. All of those years have very disconcerting rings to them. Again, not saying it has to be true again, but we'll see. So the 2024 analog perspective suggests caution history does rhyme, and we've made almost exactly the same two paths as late 24, right before a big correction. The megaphone pattern on the left is pretty reliable, not infallible, but very reliable. The market crash indicator, discretionary over staples. That one doesn't usually get it wrong, so they suggest caution. The 2000 analog has been flogged to death. Similarities are striking. Again, doesn't have to be horrible, but it could get bad. Lots of opinions on stocks. The wick-off patterns, they're pretty accurate. We got the S&P in the middle. You got the small caps on the right. And okay, so this guy's a little promotional. Don't miss the opportunity of a lifetime. Last chance. I mean, 29, 2026, those are some extreme numbers. All right, third year of the presidential cycle, always tough. Sell in May and go away. All right, surprise number 4. What do you mean it doesn't look good? Sundown, who's taken over as Mavericks Rio after the Goose tragedy, continues. It doesn't get to look any better than that, as he exhorts Maverick to take a clear shot. His words could easily apply to U.S. stocks, and particularly the Mag 7, as their stock price charts are truly Top Gun plaque-worthy after soaring to new all-time highs. Maverick's negative perspective echoes all of us, self-proclaimed value investors, and you're looking at them, who look at the extreme valuations and feel like there's an elephant sitting on our chest pressing the oxygen out of our brains. That oxygen went right into the AI bubble blowers through the never-ending series of circular deals that shoot down short sellers like Mav shoots down MIGs. Some of us hear the immortal words of Jester. That was some of the best flying I've seen yet. Right up to the part where you got killed. Surprise in 26 would be the planes out of missiles and ammo, and the only choice left for investors is to pull the eject handle, unless, now I'm blanking on his name, Glenn, the new movie, my new favorite movie, Maverick, Hangman, unless Hangman shows up. Best performing stock in 25 was SanDisk, spun out of Western Digital, up 75%, and it's actually up more because, again, I made the slide a couple of days ago. Bull market is engaged. Hedge funds are all in. Everybody loves a winner. Let's just buy the winners. Why is SanDisk up so much? Well, hardware memory is the choke point for LLMs. So technical chart on the left-hand side, it basically says that, LLMs, yeah, you need GPU processors or transformers, but at the end of the day, you're processing data that has to go back and forth into and out of memory, and DRAM prices are going to double this year because we just don't have enough. And so when memory prices are flying, memory stocks are going up. Taiwan and US are talking about a deal that could fuel the bubble. TSMC dominance. I mean, you look at it versus Intel. They're just crushing Intel. Look, NASDAQ to M2. Yes, the valuation is the highest ever. And yes, the concentration in the most expensive names is the worst it's ever been. Okay, that's fair. Majority of Mag 7 did lag the S&P. Yes, 5 out of 7 underperformed, but the 2 did really well. So Mag 7 actually did beat the S&P in 25. It was close. The Mag 7 dominance has dissipated. And in fact, now investors believe the, less magnificent 493 will beat Mag 7 this year. Mag 7 has been downgraded to the terrific 2 or 3, depending on how you want to count. So only Alphabet and NVIDIA on the far left outperformed last year. The correlation between the Mag 7 members has fallen to 0 because now the market isn't just saying all stocks are good. It's basically saying, you got to show us, except if you're in Microsoft or NVIDIA. Those two, because of the way indexes work, now make up 15.6% of all equity exposure. That is insane. That will end badly. I'm not going to tell you when. I don't know. But if you look at the history of when IBM was 10 point something, or when Microsoft and GE, when Walmart, we know what happens next. They don't stay there. So NVIDIA's dramatic outperformance, absolutely. They crushed their competition. Their second gen chip, not their current gen chip, their second gen chip actually outsells all the other competitors, AMD, Huawei, etc. However, on the right-hand side, it does kind of look like 2000. And everyone says, no, it can't be like 2000. Well, it can. And I think the TPU, GPU thing that's going on between Google and NVIDIA is an example of that, and the Grok acquisition. So we'll see. People were perplexed that Tesla's been flat for the past year. Maybe it's because it's like crazy overvalued. Like NVIDIA's crazy valued at 57 times, but Lilly 49 times, Meta at 26, but Tesla at 242, that's overvalued. Palantir makes Tesla, though, look like a value stock. Palantir is twice the price to sales at 75 times. 75 times sales. More than 2.5 times the second highest in the S&P. So, yeah, it's a good company. I'm not saying that. It's just there's risk there. The hyperscaler Stein's law. If something can't go on forever, it will stop. So linear extrapolation on the left, everybody's saying that, oh, we're going to need 1,000 terawatts of power by 2030. No, we're not. Because we're not going to keep brute forcing everything and keep demanding so much. Well, one, we can't get enough memory. But two, the hyperscaler CapEx is already starting to roll over, and it's going to roll over sharply at the end of this year and in 27. And you can see the number of projects that have already been canceled. So they make the announcement, you get a bunch of politics, you get a bunch of, government handouts, and then you quietly cancel the project because you don't really want to build a nuclear power plant. So there is also something concerning about the circular nature of the tech landscape. The entire U.S. economy right now is 7 companies sending $1 trillion fake dollars back and forth. And it does create a systemic fragility to the markets that has me nervous. And look, Sam is writing checks. His bank account can't cash. He, quote unquote, did this deal with Oracle. Oracle went up $300 billion in an afternoon. Everybody thought Larry made a bunch of money. It's now given back $400 billion. And it could go down a lot from here because Sam doesn't have the money to give to Oracle, and Oracle doesn't have the money to give to the bondholders. So that could get ugly. Now, the good news is that AI revenues 2x'd in the past 7 months, left-hand side. The bad news, 85% is OpenAI and Anthropic. So there's not really a lot of other people doing well. The really bad news is on the right-hand side, which is where, ChatGPT used to have a 50% market share. Now it's sub 25%. And Anthropic is now the leader at 32. But the really bad news is the growth at Google. The Google Gemini product trained on tensor processors that are cheaper for Google than they are for OpenAI, who has to pay NVIDIA. This could get ugly. So 2026 shaping up to be an epic M&A or IPO year. Be careful what you ask for. So OpenAI says there were somewhere between 630 billion and $1 trillion. I'll take the under, way under. SpaceX says they're worth well over $1 trillion. I'll take the under, but we'll see what happens because we've seen this movie before, guys. 2025, lots of mega IPOs, most of them below where they started, a couple of them up. I mean, there are a couple that have done okay, but the trend is bad. That pink line trend is bad. That red line trend is bad. So we'll see if they can live up to expectations. My guess is they won't. All right. AI impact on software showing up in prices. Wow. I mean, NASDAQ up a lot. Software used to make up most of the NASDAQ 100, and now it has been falling like a stone because they're afraid that you can generate all your software by yourself with AI. This follows the standard path of tech valuation, right? So software as a service is now somewhere between step 5 and step 6. It starts with EV to TAM or EV to eyeballs. Like I'm going to sell one shoe to every person in China or whatever. So then it goes to revenues. Well, then you got this thing called profit. Well, you actually have cash flow. Then you have free cash flow. And then you get to estimated cash flow. And then, oh, God forbid, you get to asset value. So that's how you go from a growth stock to a value stock. SaaS companies, the drawdowns are brutal, like 50, 60, 70 plus percent, 17, 18, 20% weeks. And the forward PE ratio has given back all of the gains from the past decade. Crazy. Risk happens fast. Small cap beats large cap 13 straight days. Second longest streak ever. And that is after just being dominated for a very long time. And it's because, look, earnings, it's a lot of small numbers. Earnings at small cap companies, since 40% of them don't make any money, the ones that do, their earnings could go up 60 plus percent. SPX dominance over small caps has never lasted more than 5 years. We had 5 years. So long, small, short, large might work. Small cap positioning has been on the rise, left-hand side. The Russell 2000 versus the S&P has broken out of resistance and is surging in 26. I mean, that's 9 points of relative performance in a couple weeks. All right, surprise number 5. You two really are cowboys. President Trump has been channeling Maverick lately through a series of aggressive moves in Iran, Venezuela, and now Greenland. His attitude is reminiscent of the infamous line to Charlie after Maverick follows in the ladies' room. Well, I guess when I see something I want, I go right after it. As usual, most of these moves are inextricably linked to natural resources, primarily oil and rare earth minerals, with the recent takeover, quote unquote, self-proclaimed, of Venezuela's 300 billion barrels of oil, which is not going to happen, being the most relevant to this particular surprise. Trump knows very well the popularity president and party are inversely related to gas prices at the pump and has set a goal of sub $2 gasoline by the midterms. Consensus believes in lower prices, so the surprise in 26 would be the fitness report says it all, flies by the seat of his pants, totally unpredictable. The two cowboys buzz the Iran tower too closely and oil prices soar. So oil never caught a bid in 25. Now, big oil did trounce crude. That helped the surprise from last year. So Goldman says excess global oil inventories will pressure prices in 26. A lot of stuff on the left. But the inventories actually look pretty low to me, so maybe that's not going to be as bad as they thought. Goldman their clients are the most bearish on oil they've been in 10 years. Now, are oil prices low because Goldman clients are short, or are Goldman Sachs clients short because prices are low? It's reflexivity again. So the GSCI lagged financial assets during the everything bubble, follows rates. Rates went down, so GS commodity index should go up. It's mostly oil. All right, GSCI has lagged due to the oil overweight. Economic data favors a catch-up. Precious metals have moved to unsustainable levels versus gold versus oil. So it used to be that it took about 25 barrels of oil to buy an ounce of gold. Now we're up to 61, or with an ounce of gold, you could buy 25 barrels. Now it's 61. An ounce of silver can now buy a barrel of oil with change. It's actually 1.5 barrels. And the energy stocks versus gold miners are starting to plumb levels we haven't seen again, except 2 other times. Now, not everyone is bearish on oil prices. History says precious metals and oil are highly correlated. If you look at the chart, they're super highly correlated. And one would say that $200 oil is not out of the question, according to this chart. Now, I'm not saying this chart's right, but it's a pretty interesting chart. Metals ran dramatically in the second half of 25. Energy stocks began to follow. Will they break out? Looks like they have. Literally, though, no one owns any energy stocks. In fact, most people are short energy. Now, interestingly, Elon initiated this thing called the Macro Hard program. He always does things that get the clicks. In August, he said you should focus on what AI can't make. So essentially, long hard asset, short software. He basically hit the bottom. I mean, almost. He was about a month early. But it's been a great trade since. U.S. oil production continues to surge despite a rapid decline in active wells. That is actually negative for oil prices. Probably not a coincidence that Venezuela was ramping oil production or oil sales to China before the raid. And it's not a coincidence that Venezuela owns the largest number of reserves and they're all sour. It's just, again, not a coincidence. Now, we're not going to control them. We got a few as a reward, I guess, but they still belong to Venezuela. Oil prices got short-lived momentum on the Iran threats. So you can see Trump threatened to go after Iran. Oil prices, cruised all the way back to the 200-day. And then he said, all right, the killings have stopped, so I'm back. I'm not going to do it. And oil prices went right back down. All right, surprise number 6, son, your ego is writing checks your body can't cash. The not-so-mighty greenback had a truly Bruce Banner year in 2025, shedding 10% of its value relative to global currencies. Uncle Sam got bad reviews as well, as U.S. debt got downgraded below Germany and Canada, no less. Oh, my gosh. The quote from Commander Stinger begins with, "You don't own that plane, the taxpayers do." But it appears our public servants in D.C. didn't understand, wrote far too many checks their bodies couldn't cash, incurred record debt and deficits, triggered a year when even the lowly euro trounced the dollar. As the petrodollar system began to unwind, the China began to make big moves to secure RMB-denominated trade. It became clear that a new monetary order could be forming. Viper said it best. A good pilot is compelled to evaluate what's happened so he can apply what he's learned. So the surprise in 26 would be we learn from our recent mistakes, make hard decisions about the budget, and the dollar goes back to being Top Gun. I'm kind of doubtful, but we can hope, and it would be a surprise. So the dollar's role as global reserves has been eroding over time. It's still number one, but it's got the downward arrow. And for the first time, it fell below 50%. Precious metals starting to give off hyperinflation vibes. This is not a prediction that we're going to the Weimar, but when precious metal volatility gets to the levels it's getting, it has led to these types of things. So everyone, and I do mean everyone, jumped on the debasement trade. So as you would expect, the dollar said, well, if everybody believes it, then it can't be so. So the dollar actually strengthened a little bit here, which, we'll see how that plays out. If the dollar downtrend were to continue, it would favor international markets. Okay, that's interesting. Most people are underweight international markets. And interestingly, international markets are far, far cheaper. So if you've got to own something, you might as well own what's cheap. The dollar dominance shifted in 2025. So left-hand side, emerging markets had been underperforming for a very long time. They looked like they made a beautiful inverse head and shoulders. I mean, beautiful. And we're about to go through the neckline and could take off. And on the right-hand side, you can see relative. It started the beginning of last year. So this goes all the way back to the beginning of 25. And now we've broken through the 200-day moving average. This could be a durable trend. Interesting. All right, surprise number 7, she's lost that love and feeling. Ms. Lagarde came in 2025 firing ECB bazooka shots all over the continent in a target-rich environment, given low levels of growth, receding inflation, lackluster capital markets. Liquidity fueled some fancy flying in the European equity markets as Fez Euro Stocks 50 surged 40%, and EUFN, the banks, soared 68%. Curious part of the movie was that despite earlier cuts than the US or Japan, the euro jumped 12%. Currency strength, the last thing EU countries needed given their predilection toward exports and mercantilism. Or perhaps it was just Christine's turn in the FX hot seat, and that will change in Davos, which is happening as we speak. Things got spicy this week with a threatened trade war against EU countries that didn't support Trump's desire to get Greenland. But before we could even write about it here, Trump did the usual Wednesday taco. Trump always chickens out. The surprise in 26 would be that the loving feeling is truly gone and European markets are the global laggards. It's pretty bad when the consensus isn't really sure if you're going to have growth or stagnation. IMF forecast the lowest growth in the developed world for European Union and the UK, except in the periphery. But at least there's not much inflation. But is not having inflation really a good thing? Is deflation really what you want, particularly if you're a mercantilist? Probably not. Crafty Christine cut first, but the euro kept rising. Now you've got 50-50 odds of a hike. That's probably, again, the last thing that mercantilists need, but we'll see. We definitely know the last thing they needed was a rising euro. But the pause in cutting rates did pause the bleeding in the euro appreciation. And I guess it was actually 13.5, not 12. Against all odds, European equities surged over the past year, banks up the most. Now I put suddenly in air quotes because in the lower left, you can see that this is not sudden. In 1865 through 1869, so 4 years, Andrew Johnson tried to get Greenland. William Howard Taft in 1900 tried to get Greenland. Harry S. Truman offered him $100 million in gold back in 1946. They probably should have taken that one. So Trump just wants it, right? And he said so much, and it's a little small. I apologize. But he said, I just want it. Okay, fine. Others say it's because he got snubbed with the Nobel Peace Prize and he's just striking back. Well, the EU didn't just roll over. They actually decided to fight back. Now, Trump's threatened tariffs were meaningful. We're talking 1 to 1.5% of GDP. So the likelihood of the taco was very high. Europe wasn't completely defenseless. They own lots of assets. Now, the interesting thing is somewhere between 2 trillion and 3.6 trillion. Now, it's not really 3.6. That red no symbol, the UK is not part of Europe. So you take that 900 out and you're at 2.5 or 2.7. So somewhere between 2 and 2.7. So within $500 billion, we know how much treasuries they have, which is ridiculous. And sell they did, right? They sold a bunch this week, one of the largest sales in history. And so they didn't just sit back. And we barely had time to make the Greenland slides before the taco backed down. So we got a Greenland taco. And look, the people in Denmark were kind of saying it's not for sale. So, all right. This is, I won't read it all here, but this is something that these guys at Kobayashi Letter did a year ago during the trade tariff debacle. And they said, this is what Trump's trade war does every single time. Starts on a Friday. He does some stuff on Saturday and Sunday. And then he starts again on Monday. And by Wednesday, you get a relief rally because he backs down. And it was on a Wednesday. I mean, it's crazy. All right. Surprise 8, goodness gracious, great balls of fire. 2025, turbulent year in Japan as Bank of Japan Governor Kazuo Ueda pledged to reverse the policies of Abenomics and strengthen the yen. True to his word, USJPY rallied 10% by April, but unfortunately the Nikkei shed a third of its value and political upheaval followed. LDP shakeup led to Sanai Takaichi being elected PM in October, running on an extreme populist and nationalist platform. She promised a massive stimulus program to try and prop up the long moribund Japanese economy. She doubled down in early 26, calling for snap elections to try to take greater control of government, promised a large unfunded tax cut, is now being blamed for the sudden unraveling of Japanese bond markets. The yen carry trade has supported global liquidity for years, so the surprise 26 would be bad policy and poor leadership, trigger unwinding. The rising sun turns into a great ball of fire and subsumes Japanese debt and equity markets. All right, most people, surprises included, didn't have Japanese equities as some of the best performers. Japanese stocks hit new all-time highs. And, Takeichi thought that it was because she was so popular. Well, not so much. So a populist mandate definitely can get you elected. Nikkei momentum can get you elected. And so she decides to make a very bold call for snap elections and say that we're going to do a food tax cut with no funding, which appeals to voters, but didn't appeal to the people who are in charge, which are the bond vigilantes. So $1 trillion here, $1 trillion there. Pretty soon we're talking real money. So she announces this big cut. The bond vigilantes come in and say, hell to the no, and they crush Japanese bonds. So has she lost control? Is she even going to survive the year? I actually think she probably doesn't survive till mid-year. The bond vigilantes came after her, not a fan of unfunded populist agendas, and bond rates in Japan have gone totally parabolic. So people are jumping on the losses in long JGBs at 50%, 52%. They're not different than the U.S. Treasury losses of 50%. So now, yes, they have more debt, but they also own their own debt. They own a little over 50% of their own debt, so they can cancel it at any time. So it's complicated, but it's not as dire as people think, but it's real, and the unwinding of the carry trade is real. Japan does have 4 times more debt than Germany, so it could get disorderly fast. So far, it's been monetary policy mistakes more than macro shocks. And look, Takeichi is not long for this world if she keeps doubling down on bad decisions. The other problem is maybe she's not in charge. Maybe she's a puppet for someone else because she has gone way deep on this Taiwan thing and hurting relations with China. She's caused this renminbi yen issue to come to the forefront again. President Xi basically doesn't like it. So there's probably a bigger geopolitical issue going on here. My guess is, like I said, she came out of nowhere. She'll probably go back to nowhere. All the while, Japan just ceded 4th place to India as decades of stagnation caught up. So India is now the 4th largest economy in the world. Japan now number 5. Remember, it was in the top 2 not that long ago. The yen is back to 86 levels. Now, in 2011, green arrow on the far left, Hugh Sloan said to me in his office in London that the yen will be lower for the rest of your life. Well, that's a big statement. And sure enough, here we are. And the Bank of Japan has fought, to stop it, but they have been unsuccessful. And hedge funds now are piling on, and they're the most short they have been. My guess is the yen weakens a lot, unless the Bank of Japan comes in to save the day, which we'll talk about. Complete decimation of the yen in gold terms has demanded they change their reserves. So you can see they used to have more dollar-based and yen-based, mostly dollar-based FX reserves. Now they have gold. So everybody's wondering, where did all the gold buying come from? Well, here's one place. So all eyes on Friday's BOJ meeting tomorrow. Will Ueda-san buy bonds and stop the bleeding? So this was a 6 standard deviation move on Tuesday. And the Bank of Japan, again, look, I said, they own lots of bonds. And they had been selling them trying to normalize their balance sheet, but they may, like the Fed, have to go the other way. All right, surprise number 9, you are still dangerous, but you can be my wingman anytime. First half of 2025 was all about on again, off again tariffs and trade war between the U.S. and China, while President Trump consistently threatened and then backed down, earning him the taco Trump always chickens out moniker. President Xi consistently refused to fully engage and just kept quietly playing go, gaining relative advantage all around the board. AI, 5G, trade. The DeepSeek moment was a turning point as Trump had his Iceman experience and realized that while Xi may indeed still be dangerous, he clearly knows how to fly a jet, and perhaps he could be a worthy wingman. Xi's response was very Maverick-esque, BS you can be mine. Trump dragon Trump's eagle, ha ha ha, in this game. Debate will rage on which side is winning, but it's clear that China has figured out the next global superpower will be secured by chips, not ships. Surprise in 26 would be China doubters are wrong again, and the dragon market continues to roar. China Tech and Mag 7, dead heat last year. China Tech EPS going to accelerate. A tailwind to this is emerging markets are undervalued relative to international and U.S. markets, and their growth is better. Gold, copper has always been a nice leading indicator for emerging market equities, and emerging markets are the cheapest of all. So 2 big important points to remember about China. China dominates Asia, which is the largest population in the world. It also dominates rare earth minerals, which at the end of the day, a lot of what all this nonsense is about is that. China is simulating the economy at extreme level, paving the way to become the superpower. Top contributors to world economic growth, China and India. Again, Asia, not the US, Indonesia right there. So if we think about China's long-term goal to be the superpower, not just a superpower, they're playing the game pretty well. Their surplus soared to 1.2 trillion. They added 200 billion in the fourth quarter. And the surplus changed. You can see on the far right-hand side, U.S. trade went down because of the silly tariff war, but they increased by more to Africa and ASEAN. So they're playing a different game about relative advantage. China is selling their treasuries and buying gold. Okay? It's as simple as that. So the other reason gold went up a lot is China was buying a lot of it because they want to fully back the renminbi, make it convertible, make it the global reserve currency. That's interesting. All right, surprise number 10. In case some of you are wondering who the best is, we said in last year's surprise that our Bitcoin view would be very unpopular, and most would say there's no chance it could play out because the 4-year cycle was dead. Institutions had arrived and were here to stay, and 150 was far too conservative to be the cycle top, even though the cycle was dead. I like that part. It's not to say we're happy that the 311 cycle is not dead, and we have likely entered crypto winter, but Viper's speech to Maverick and Goose rings in our ears. The rules of Bitcoin engagement are written for your safety and for that of your team. They are not flexible, nor am I. Either obey them or you are history. Some license to emphasize that humans always going to human, so it's really the rules for Top Gun engagement, not Bitcoin. And you have to obey the rules of engagement. Excess leverage must always be cleared. So the fact is Bitcoin is the best of the best form of money. The surprise in 26 would be we muddle through until fall and resume the inexorable rise to a Bitcoin standard. So Bitcoin is dead flat past 12 months despite many positive milestones. And look, on the right-hand side are all the experts who thought Bitcoin was going to go really, really high last year. I mean, some of the numbers are silly, like Kathy Wood's $2 million. But, you know, the fact that we were at the low end at 150 and it ended up at 126 feels pretty good. Bitcoin died again 4 times in 2025. We're now up to 450 obituaries since 2009. The other thing you got to remember, people compare it to tulips. The tulip bulb mania lasted 9 months. Bitcoin has lasted 17 years. All right, rough Q4 for Bitcoin. Basic construct is unchanged. They print, we stack. So they're going to keep printing money, and the more they print, the more we stack. Quick reminder of what Bitcoin is. It's better money. It's the first money that requires no physical space to store it, no courier to carry it, no bookkeeper to count it, no auditor to check on it, no security guard to protect it, no government to issue it. It is insurance against central bank profligacy. People claim Bitcoin's not scarce. Yes, you can copy the code, but you can't copy the network. 11.6 thousand coins failed last year. 12,000 coins failed last year. Bitcoin didn't fail. Its number of non-zero addresses just keeps going higher. You can't copy the network. CME open interest 3 times 2021 high in 2025. Deleveraging was swift, right? There was a lot of deleveraging. Again, the rules of engagement were not followed. A lot of deleveraging in 2025, but short interest is now down 90% in a few weeks. Bitcoin was under pressure during the largest liquidity drain ever. What if it turns? Bitcoin's sentiment, okay, has turned. We're deeply oversold in Q4. Now we're back to positive. Everyone focused on the Benner chart, even the Bitcoiners. Could it be as simple as follow the money? There's going to be $4.7 trillion of liquidity unleashed this year in 3 phases. 1.2 trillion of tax refunds, 2.1 trillion of corporate dollar repatriation, 1.4 trillion of bonus depreciation. That's 3 times the 2008 bailout, 20% of US GDP. We could get a big blow-off peak. And this is saying Bitcoin could go to a couple 100,000. I don't know, but it's interesting. Bitcoin flows turned positive again after a very challenging fourth quarter. Follow the money. Bitcoin's historically correlated with gold with a lag. It's all about M2. Follow the money. Bitcoin's never been this undervalued relative to gold. It's unlikely to stay there. If it reaches gold, it's 165. If it reaches silver, it's 284. Doesn't have to do either one, but it's interesting. If SCOTUS strikes down the tariffs, expect a VIX explosion, big market sell-off, big VIX explosion, but a bull market for Bitcoin because they will have to print like never before. Now, the Bitcoin power curve model, it kind of broke down. It said 210,000. We only got to 126. Maybe it needs some revision. We'll see if they do. Different models for determining fair value Bitcoin. We prefer Tim Peterson's N squared. He says the lowest price forward today is about 70,000. His fair value is closer to 91,000. He does think that 2025 is going to be interesting. You know, the sell in May and go away in the markets. You know, if you sell your markets and buy Bitcoin, maybe that'll be a good trade. Bitcoin trading under total production cost rarely falls below mining cost. Mining cost about 71K, same as that lower price forward. Total production cost about 90K. Interesting. The hash rate did come down, right? We went into liquidation. Hash rate came down, minor capitulation. It is interesting / disconcerting that 60% of global hash rate is in the US, Russia, and China. So despite the fact that China banned it, some believe we've replaced bananas with cucumbers, that we're not going to have these parabolic moves. We're going to have these, more meaningful adoption. Institutions are here to stay, right? In 24 and 25, they bought 4 to 5 times the production of Bitcoin. So maybe the drawdowns will be smaller. We had a 35% drawdown. Maybe that's all we're going to have. The stock to flow model also probably needs some adjustment, but it's saying, we're headed to, that 500,000 level for the next halving. And if you look at the swirl, each circle of the tree ring goes an order of magnitude. So it goes from 10 to 100 to 1,000 to 10,000 to 100,000. We're right on the $100,000 line, and we'll end up at the $1 million line over a period of time. Fear and greed index, very likely to see an extended rally from here because we're at 20% and we're bouncing off the bottom of 10. Best investors resist the lure of the calendar of the masses. When everybody's saying up only, you should be nervous. That's the red boxes. When everybody's saying, recession's coming, recession's here, bottom is in, maybe you should be thinking differently. Not everyone is bullish on Bitcoin. Some of us still believe in the 4-year cycle, and some believe that it could go down. This guy saying in 32K, I think that's way too extreme. He just doubled the previous bottom at 15. There are others that think that, 70K is a more meaningful bottom. I kind of come out there. Peter Brandt, old school technical analyst, says the banana zone, we're on the way to the green line. So we've already peaked back in October. We end up at the green line, that's 63.6 sometime in September, October this year. It's pretty interesting. Bitcoin could be stuck in a channel for a while. Unless we break above 98, we're probably going to be stuck in the channel. When you have 3 monthly declines, you usually go up 15%. We're already up half of that in January. The taco trade saved 7 down days. So they printed this chart. We're going to have 7 days in a row. Trump chickened out and market reversed. So we actually had a green day yesterday. So this would have been the 8th day. We almost never have 8 down days in a row. We've only had 7 down days 4 times. So was unlikely. Crypto more broadly, rapid growth. Exchange volume accelerating, RWA tokenization accelerating. Usually a good thing when the world's smartest investors agree on an idea. So Figure Technology is one of our largest investments. It's more than tripled at one point off the bottom. And people like Stan Druckenmiller, Chase Coleman, Philippe Lafont, George Soros, they all bought it. That's a good sign. We like that. Ethereum is the preferred blockchain for RWA. ETH has been a volatile ride, but if you drew a line, that is an upward movement. So it is still the dominant player despite Solana and everybody else saying it's not. It is the dominant chain in stablecoins, the green lines on the upper left, and transactions touched a new all-time high. Interesting, the gas fee problem, everyone's saying Ethereum's too expensive because gas is too high, have collapsed because they can spread the gas out over more transactions. Look, stablecoins are the rails of the machine economy. Everything is going to be driven by agentic AI payments. That is coming, whether we like it or not. And it is going to settle on stablecoin rails. So while the fuss about the Clarity Act, because the banks are trying to protect $300 million a day. They get paid $300 million every single day by the Fed. So yeah, Brian Moynihan says, yeah, $6 trillion would leave the banks and go into stablecoins if you could let them pay interest. So we can't allow that. Well, sure you can. I mean, that's what technology is. That's what competition is. But they are trying to do regulatory capture here. And, as Brian said, no bill is better than a bad bill. All right. Last surprise, bonus surprise 11. He's going vertical. So am I. Always feels funny to be directionally right, but so very wrong on the magnitude of the surprises was the case with gold. Gold blew right through our hard deck at Q1, just kept climbing all years. The shorts got squeezed hard. Investors did what they do best, bought what they wish they would have bought. As gold prices went nearly vertical, a new pilot entered the dogfight late in the year, and silver streaked past gold as if it were standing still. When the monetary metals move up and they both go parabolic, they start to give off some real debasement vibes. Many jumped on the debasement trade moniker. Ray Dalio even commented at the opening of Davos on Tuesday that a new monetary world order was emerging. As global central banks bought gold like it was going out of style, consensus started calling for 5-digit gold prices. Surprise in 2026 would be precious metals take a well-earned pause that refreshes. 3,000K target, it was cute. 5,000 really is not that high when you look at 3,500 inflation adjusted 80 peak. So we're really not crazy numbers yet. Metals dazzled in 25, gold's best performing asset this decade. When gold outperforms the S&P, it usually goes for a long time. So this could run for a while, actually. Gold has crushed stocks this century. Longer term, stocks still winning. Gold is now the most crowded trade. But again, history shows that when the metals start running, they can run for a while. Precious metals tend to positive and negative versus the S&P for long periods of time. Silver and gold are both looking like they want to get better relative to the S&P. Now, it doesn't necessarily mean gold and silver have to go up. It could just be the S&P goes down. Silver exploded in Q4, surged back to the second largest asset in the world fast. I mean, it blew past all those companies like they were standing still. Silver most overbought, shockingly, since 1980, tripled off the April lows, and cute, up 27%. The chart's a couple days old and it's up more. Silver looks like it's run hard until you adjust for inflation. Then it's not even close to the Hunt brothers squeeze. Global central banks buying gold literally like there's no tomorrow. There is a monetary regime change going on. Russia and China, India, they're all buying gold. Foreign central banks now own more gold than treasuries, middle chart. That might be the most important chart of the whole day. Gold, central bank gold accumulation dwarfs retail ETF buying. The average investor has barely 1% in gold. So the real kind of buy what you wish you would have bought bull market hadn't really started yet. So gold miners leverage exposure to gold. That chart is beautiful on the right. Now, it's a little overbought, but it's a beautiful chart. All right. Latest podcast around the world. I can't spell hedge without a capital D. Can't spell edge without hedge. Can't spell hedged without edge, man. And then every week, X and I rap about digital currents. Still love these books, and I'm way over time. I know there are probably a few questions, but all right. So what happens when the U.S. debt crisis hits? What do? We pay the higher rates and continue to kick the can down the road. Again, it is the $64 trillion question. I do think for a while we kicked the can. We increased the budget deficit. We print more money. And, the K-shaped economy gets worse, rich get richer and the poor get poorer. And, at some point, what would stop that? Well, pitchforks or something else. But, all right. And can the slides be shared? Absolutely. We'll put them up. And the file's huge, so we have to send you a link. So just send if you want the slides, send an email to Erica or Leslie, and we'll get you a link to the slides. Expand on the K-shaped economy, boring consumer staples. Yeah. So I think the challenge is, again, fantastic question. The challenge for playing the K-shaped economy is one would think that in this environment, you could downshift in consumer stocks, like you go from, Macy's to Target or Target to Dollar Tree. The problem is those things have been getting cremated because the bottom of the pyramid can't even shop at Dollar Tree right now. I mean, they are struggling so badly that those stocks have been hammered. So sadly, the way to play the K is to play the rich people side. So to buy the silly names like Abercrombie and the cruise lines and the place where the rich people are still going. I don't love it, but it is what it is. And I don't know what's going to change it, but I do think it's going to take some time. And we just need better leadership. And again, I don't mean that at the presidential level. I mean it at the congressional level. We need term limits. We need young people. We need new ideas. We need limits on insider trading. We need limits on soft money contributions. We just need to start over. But We just need better leadership. And until we get that, cronyism is where we are, right? We're at the late stages, post-capitalism, into cronyism. And that's what led to the downfall in Rome. It's what led to the downfall in Germany. It's every great civilization ends the same way, that a small number of people control everything, and, there's an uprising. Now there's also other things like, plagues and we probably don't have that kind of stuff. But anyway, longer story. I could take questions all day, but I do want to be respectful of people's time. So zero real growth in spending for 10 years. Yeah, generation of sacrifice needed. So what I think I'll do is I'll just stop here. If people do have questions, again, you can send them to Leslie or Erica, and we'll try to respond by email. We'll put up a link to the slides. They'll be on the Around the World website with a recording of this at some point. So we'll make that happen. I appreciate everybody sticking with me to the end, and we'll talk again soon. Thanks, y'all.